Hi everyone, so in this video I want to do an update for the beginning of November. So we can see here the portfolio value is just encroaching $8,000. So we peaked it last month, dropped down, and we're just sort of peaking up there again. We've had a dividend income in October of $7.99, so slightly less than in September. However, there was just less companies paying dividends this month. We have seen a big increase in Q3s coming out, so it's sort of this time of year that the third quarterly reports are released. So I've been reading through some of those, and I'll bring you an update on the UK banks, which I think are quite undervalued, which we'll cover shortly. So the largest holding I have in a UK bank is HSBC, which we can see here is just about even. It's only $267. And I also hold NatWest Group with a small holding, however, it's at 32.6% profit, which is a big regret. I should have made more use of the opportunity. It also pays a very healthy dividend at 20%, so I really should have taken more opportunity. However, it's a learning opportunity. HSBC cancelled their dividends this year. It's likely to return based on good financial performance in early 2021 as an interim dividend. So the basis I want to go off the analysis for the UK banks is I've been reading through the Berkshire Hathaway letters to shareholders, and this is really interesting. You can Google this as a PDF. I think it's about 50 quid, £50 to download, to buy. Sorry, the actual paper version, but you can just Google the PDF and find it, and it gives a great rundown of the history of Berkshire. So it starts off at the struggling textile mill of Berkshire Hathaway, and then they slowly acquire businesses, and it shows his great forecasting skills, and it just shows the evolution of Berkshire from all their holdings throughout time, all their sort of losses and profits, and it really gives an honest overview of the company, which is quite good to see. There's no sort of management jargon. It's like as it is, and it shows just how skilled Warren Buffett is as an investor. So from a 1971 extract here, we can see his purchase of the Illinois National Bank. In 1971, he discusses the earnings. So what he was impressed with was the 2% after tax on average deposits, not using borrowed funds, maintaining a liquidity position above average, recording loan losses far below average, and utilising a mix of 50% time deposits, consumer savings account. So I've taken two of these points, 2% after tax on average deposits and maintaining a liquidity position far above average, to compare against some of the UK banks. So here we have the key financial metrics. So we have the liquidity coverage ratio, which is the liquidity over expected outflows, and here we can see Barclays is coming out on top. So it's got 181% liquidity over the expected outflows of the bank. So the UK banks in general are quite good. So anything above 1 is sort of considered safe. You ideally want it a bit more than 1 just to give yourself some leeway room. But Bank of America at 122%, and the lowest UK bank being Lloyds at 138%. The net interest income margin of the bank this in Q3 2020, Lloyds comes out on top at 2.54%, with HSBC being the lowest at 1.35%. The CET1 ratio, which is the bank's capital over assets in Tier 1 capital, which if you don't understand it and you need further clarification, just give it a Google of CET1 ratio. However, I think the expected amount to remain not solvent is over 4.5%, so anything a bit high is good. So NatWest coming on top, 18.2%, and the lowest being Barclays at 14.6%. So compare this to Bank of America at 9.6%, it's quite good. The return on tangible assets, so that's how much the bank makes in return for its tangible assets deployed. So Lloyds coming on top at 7.4%, NatWest recording a loss at 2.7%, and Bank of America just about even at 0.54%. Looking at the price to earnings from the current stage in Q3 2020. I'll take this with a bit of salt, seeing that the earnings and revenue of the banks, through reading their 10Q is down about 30 to 40% average, which is expected. The low interest rate environment makes it very hard for them, along with the ongoing panic. And for UK banks, the uncertainty in the investment in the Asia Pacific region and Brexit. So we've got NatWest at 18.88, Lloyd's at 67.88, which is very high, HSBC at 22.2, and Barclays at 9.3. Compare this to Bank of America at 11.9. So you can see here that Barclays is coming out on top so far. So it's got high liquidity, high PE, low PE, sorry. And another metric that's really useful is the price to tangible assets. So this uses the price per share over the price per tangible asset, price of the tangible assets per share. So this is essentially the banks are selling below. We can see here with a sort of below one number, sorry, that the banks are actually selling for below the price of the total tangible assets, which is very good. So if the bank were to get liquidized, for example, there's more assets in the current market capitalization of in the stock market. So NatWest at 0.47, Lloyd's at 0.54, HSBC the highest of the UK banks at 0.59, and Barclays at 0.41. So compare this to Bank of America at 1.21, so they have 1.21 more. The price is 1.21 times more than the tangible assets per share, with JP Morgan being the highest, which is not included here, but however I did calculate it at 1.61. So this shows that the UK banks as a whole offer a good investment environment. They are undergoing some great uncertainty and have seen a great decrease in price. So if we go for Lloyd's, for example, we can see there has been a significant reduction in price, and the uncertainty around Brexit, around Asia and China, I think makes it a great buying opportunity. They offer great dividend yields, and it will be a great forward investment for the next sort of 5-10 years, I believe. So that's this November update video. If you have any you'd like to know, please let me know in the comments. Please give this a like, and thank you very much.